It seems like passive is winning the inflow game, no matter what you say. We've had, I think, $700 billion in inflows this year into ETFs. We've got a record year. I put up the numbers here. Most of it is passive still. Active is still a very small part of the inflows. Even with mutual fund conversions we keep hearing about. Is there any reason to think that this is going to change? Ed, you and I were talking about this earlier, just massive inflows into passive funds again this year.
Yeah, and let's start off with there's a lot of ETF models out there to start with that own passive and active. While it's been around since 2008 in the ETF landscape, has been slow to adopt, especially on the equity side. I mean, 2 years ago, at the end of, well, almost 2 years ago, at the end of 2019, the active space was only 100 billion. I mean, sounds like a lot, but when you compare it to the overall ETF space, it was a really small percentage. The end of last year, it grew to 174 billion. And the equity space was the first time it really grew. It was only 15% at 19. And then it grew significantly to about almost doubled, around 30%. But the issue you have, Bob, is a lot of these funds are new in the active space with the advent of different structures like not being able to show your holdings every day, or what we call semi-transparent. It's really been more ETFs have been coming to market. And this year alone, there have been more active ETF launches than passive. So I think you're beginning to see a lot more active come in. And I think time will tell if they can supplant some of the passive. But because they're ETFs, a lot of the ETFs have a lower fee structure than mutual funds, traditional mutual funds, because they're new products. And so having that lower fee structure can attract more to take a chance.
So, Ben, is that going to make a difference? I mean, if active doesn't outperform passive in a mutual fund space, is it possible it could do better in an ETF space if the fees are lower?
Well, absolutely. Incrementally better, Bob, to the extent that the fees are lower, first and foremost, and to the extent that the ETF wrapper might mean that those strategies are delivered in a way that's more tax efficient to the end investor who's investing taxable money in that particular strategy in a taxable account. Now, while those two things may reduce the force of gravity on active strategies, I should stress that they are not a pair of anti-gravity boots, and none of these things is a given. So we can know to an extent with certainty that the fees might be lower. What we've seen to date is actually kind of a mixed bag with respect to tax efficiency when we look at the same strategy as it's been delivered through an ETF versus an open-ended mutual fund. And a lot of that has to do with the fact that we haven't seen a lot of sort of two-way flow into these ETFs and outflows in particular, which are critical for purging low-cost tax lots and getting that uptick in tax efficiency relative to what you might get from a mutual fund. So again, a gravity reducer, but we're not talking about a pair of anti-gravity boots when we take an active strategy and convert it to an ETF, replicate it into an ETF, you name it. The ETF has undeniable benefits for the end investor, but they don't cure everything.